Welcome in and welcome back. We are here for another weekly investor, this being lucky number 13. So, over 3 months we've been doing this now. We've got 4 things to talk about and then 3 stocks that I will be watching this week. The first thing that we have to talk about is the fact that we started to see some volatility and some instability on the downside of the market around the Wednesday, Thursday mark of, did you catch my Midwest come out just then? Thursday? Around the Wednesday or Thursday mark last week. Could this be the foreshadowing of a double dip, of a W-shaped recovery, if a recovery at all? But we saw the S&P drop about 200 points in 3 days, and the NASDAQ drop about 500 points in 2 days. And the thing that's going to be interesting about this is we are approaching quarter 2 results. We're approaching earnings from quarter 2. We are at the midway point through the year. And looking forward, we have uncertainty surrounding the coronavirus, uncertainty surrounding a vaccination for the coronavirus. We have uncertainty about earnings, the entire earnings season. As this was the first quarter completely affected by shutdowns, lockdowns, not just the last 2 or 3 weeks, as quarter 1 results were, well, every business has its own sort of strategy for what quarter happens when, but the first quarter of 2020, was only affected by a couple weeks, 3 weeks, by partial lockdowns. This second quarter, ending this month, we're looking at the entire quarter basically being shut down. And we have added instability with riots that have taken place, with entire cities that have been nearly burned down, that have been hollowed out at certain points. If the coronavirus did not put enough small businesses and restaurants out of practice, how many more will be added by the fact that their entire building was burned down? I think that this is going to add to a great downside. You can go back 3 months on this channel. I've been someone who's been talking about a W-shaped recovery for quite a while now. I think that is going to be where we are heading. I think there is substantially more downside to be had here, as not for long-term investors, mind you, not for dividend investors, if you will, because I think that a lot of the turnarounds will be for people who had, at this point, already taken profit in their positions. So if you bought your stocks in 2010, for example, a lot of your positions are going to be up markedly from then. Why not cash out and find something that is going to have a bit more of a sure future, the blue chip stocks, if you will, if you were in something that was affected that heavily by this? Why not cash out and find yourself a Microsoft, which will be coming back later in this video. The next thing to talk about, MarketWatch I read an article on MarketWatch about AT&T looking to sell Warner Brothers Interactive Entertainment. They are looking to make a cool $4 billion off of this, which is, look, you're talking about properties which will be affected, like Harry Potter games, Mortal Kombat games, the Hitman games, and Lego series games. But when you talk about $4 billion, that's the same amount that both Marvel and Star Wars sold for. Now, granted, Marvel sold over a decade ago now, and Star Wars must be coming up on the decade mark. You're looking at 2011, 2012 for Star Wars, I think 2008 on Marvel. But those are massive properties, massive intellectual properties, massive enterprises, massive coffers. That's a lot of stuff. When you're talking about Warner Brothers Interactive Entertainment, even 10 years on, when $1 billion means a whole lot different than it did 10 years ago, and $4 billion certainly means something different than it did 10 years ago, 12 years ago. I don't know how that business is going to go down, but apparently Take-Two, EA, and Activision Blizzard are all potential suitors for this deal. So when you're looking at that large an amount of offloading from AT&T, you have to be looking at what AT&T is looking to do with that money, why they want that cash, and why they want to get rid of that revenue stream. It has long been cited that video games are an extremely unpredictable revenue stream. And that is why it is rumored that one of the major corporations, such as Disney, has not gone ahead and, I mean, how many Avengers games are there? How many Wolverine games are there? How many X-Men games are there? How far back do you have to look in order to find them? There are some Marvel video games, but not as many as there should be for the global phenomenon that has been the MCU. You're talking about an intellectual property in the MCU, the largest series of movies, the most successful movie brand in history. When you're looking at an enterprise that is as successful as that, with that lack of video games, I think you start to understand a little bit more that the entire outfit of video gaming is really more of a gamble, a roll of the dice, than a business as risk averse as Disney wants to toy with. There are always rumors that Disney is looking to buy EA. I don't know how many times that rumor has popped up, but I think that what you're doing for AT&T is you're looking to minimize exposure to risk in a maximized risky environment. And AT&T, if I'm not mistaken, recently announced that they are going to be cutting their dividend, not completely, but reducing their dividend. So you're looking at volatility that the company has not adjusted for, and you're looking at a company that is... The rollout of HBO Max has not been as successful as the company would have liked, for sure. And they have had many hiccups along the way. There is every reason to believe that they are going to figure those things out moving forward. But as things stand right now, they're in a rough patch. Moving along, both Microsoft and Apple kissed the $1.5 trillion market cap mark. And I think both of those companies kissed it very briefly and then backed off. But Motley Fool posed the question, which company is going to get to $2 trillion in market cap first? And they have an article that is definitely worth reading, in which they go along that question and try to answer step by step exactly where the growth will come from. As far as Apple is concerned, they talk about pent-up demand for Apple products. A lot of that pent-up demand has to do with the 5G revolution. Some of that pent-up demand has to do with the market and instability in employment, and whether or not what's going to happen when we get back to buying Apple products. And another growth section that they have named for the company is the App Store and how that pertains to working from home. As far as Microsoft is concerned, obviously, the software that people are using to do business from home is probably coming through Microsoft, as well as growth in their Azure cloud storage department. The Azure and cloud growth for Microsoft, which saw a 59% growth in the most recent quarter. But for some reason, these growth numbers are projected to fall into the 30s going forward in 2021 and 2022. I'm not convinced. Now, maybe, so a lot of this has to do with the overwhelming lead that Amazon has in that department. You can't convince me that Amazon is going to continue innovating at the pace that Microsoft will in a software cloud type environment. Maybe they will. Hey, and more power to them. But I don't see it. I think that once Microsoft, A, really sinks its teeth into the thing, and B, starts to recognize some of this money from the government contracts that they have recently acquired, much to the dismay of Jeff Bezos and Amazon. Once Microsoft starts to recognize that money, they're going to pump a lot more of it into growth and development and innovation. Now, they have a disadvantage that Amazon does not, in that they pay a dividend, but it's not a massive dividend. And if you have, it seems, the talent that Microsoft has and the innovators that Microsoft does, I think that they are primed to continue innovating in that space. But they also did Motley Fool cite the Teams software that Microsoft is promoting and how that affects the work from home environment. Motley Fool then goes on to claim that if any company is going to hit the $2 trillion market cap in the near future, and the more likely to eventually hit the $2 trillion market cap is Microsoft, citing the PE ratio history, and the PE history, and I think a lot of that has to do with the profit margins that Microsoft really has, as they are dealing more with software than is Amazon. Amazon has a lot of physical stuff they've got to do. So I think that they are probably correct in or Apple. This is versus Apple. Apple has a lot of physical products that they put out. They manufacture a lot of stuff that Microsoft does not necessarily do, especially in the cloud revolution. The final story that I had to talk about before getting to 3 stocks that I'm going to be watching this week is that Ron Barron was on CNBC, and every time Ron Barron is on CNBC, it's basically a holiday for Tesla bulls. And in his most recent appearance, Ron Barron said that he thinks the stock will double or triple in the next 5 years, and then double or triple again in the 5 years after that. That stock in question being Tesla, of course, which means that Ron Barron has a price point on the stock for 10 years from now, a price point for Tesla by 2030 of between $4,000 and $10,000 per share. This is impressive. This is imposing. And I think a lot of what I'm going to try to put together some thoughts on Tesla, and because I think a good deal of how we think about Tesla circles too much around the cars. Now, I'm going to get slapped in the face for saying that because of the second part of this story that I'm going to be talking about in a few minutes, but I think a lot of the consternation around Tesla involves the fact that we think of them wrong. We think of them as a car manufacturer, when I think basically the way we should be thinking about Tesla is go back to 1980 and think about GE plus cars. Think about GE and Ford had a baby in 1980. I think that is basically what this company is. When you're talking about innovation, when you're talking about products that are coming out, when you're talking about different things that they're trying to do, when you're talking about a clear mission statement, I think that's what we're going for. And I think that's what is going to be realized slowly over time as they roll out more and more products. One of those products that they're not quite rolling out like they promised is the solar roof. Tesla has been issuing cancellations to solar roof customers, but this is the bad side of that is they're not going to be rolling out solar roofs, obviously, at the same pace that they had said or imagined that they would be. The good news is, when you look at the fine print here, they're canceling solar roofs for people who are outside of a certain perimeter. So that perimeter from where they are manufactured influences how profitable the roof can be, which means that Tesla is really ramping up the fact that, yes, they're trying to make money off of the solar roof. So I think that while, yes, obviously there is a lot of downside to be realized on that story, there is some upside as well. They are looking at the solar roof in terms of practicality. Now, 3 stocks that I'm going to be watching this week. Number 1 is 3M, ticker MMM, that is currently trading around the $155 mark. Despite the fact that futures are down almost across the board, which leads back to that number 1 story about, hey, things might be falling again. But currently trades around $155. The 52-week high is $187. 52-week low is $114 with a 3.8% dividend. The post-COVID roller coaster that has been 3M is an interesting one. They are a mask producer, which should be benefiting the company, but they were not able to keep up to pace. There was also a fake mask scare. This is a company that currently trades at an 18.17 PE ratio, which is a decent PE ratio for a fairly safe and standardized company. Here's why I'm watching it. I'm afraid to look at this as a missed opportunity to get into the company that is 3M. We're looking at 3M prices that are around the 20s. We're looking at entry points to the 3M company that are around the 2016 levels, which is not all that long ago, but we're coming up on a half a decade ago, right? So you're looking at an entry point that is around the 2016 level entry points. But that entry point followed a huge run in the company between 2012 and 2014. So what is the true value of this company? What does that PE ratio really mean? And in a post-COVID world, or hopefully eventually a post-COVID world, because I got to tell you, this is wearing on me at this point, in a potentially post-COVID world, how necessary and how often are masks necessary? I think, as do many people, that masks are going to become a little bit more common in the United States than ever they have been. Maybe not as common as they are in Asia, but I think that you will see masks around. Where do those masks come from? The number 2 company that I'm going to be looking at, the number 2 stock that I'm going to be looking at this week is Southwest Airlines, ticker LUV. You're looking at a stock that is around the $36 mark, a 52-week high of $59, a 52-week low of about $22.50, with a 2.01% dividend, which is about 18 cents a share. Are we looking at further downside for the airlines? Are we looking at another crash? If we are looking at another crash, is that crash as heavily focused on the same sectors that it was the first time? It seems to me that the first crash was a lot on banking, was a lot on travel, airlines, and was a lot on travel leisure, like hotels, and very heavy on Dave & Buster's and Darden, things like that, restaurant type stocks. But the restaurant type stocks were looking forward. The other ones were looking very, very now. I wonder if the stock market is going to go through a secondary crash, a W-shaped recovery. Are the airlines going to be as affected as they were the first time? With Southwest Airlines, you're looking at a stock that is about halfway in between the 52-week high and the 52-week low. So you're looking at a stock that has half bounced back. To where is it bouncing? That's what I want to know. And are we going to see the dividends at all for this company? The first dividend of 2020 did in fact pay out. Why is Buffett fleeing these positions? If not, that they are not going to have buybacks, and if not, that they are going to disallow and discontinue dividends. What was it that went into those bailouts? I don't know. I don't know that I have seen anyone who does. So it's going to be interesting moving forward to see how that works out, what that means. And the third stock that I'm going to be watching this week is Coca-Cola, ticker KO, which is currently trading around $46 with a 52-week high of 60, a 52-week low of 36, and a 3.6% dividend. I built a small stake in this company at the $42 mark. Since then, management has come out and noted that 50% of Coke's service channels were negatively affected by COVID. Think of all the Coke that you're not selling at Olive Garden. Think of all the Coke that you're not selling at McDonald's. Think of all the Coke that you're not selling at your local Quick Trip. Coke's Q1 saw a decline of 25% with only, as I stated earlier, a few weeks affected by that Q1. Where does Coke go? Where does Coke go? Motley Fool recently ran an article citing that they fear Coke is going to dip back into the $20 range. If Coke does dip back into the $20 range, it is going to mean that a lot of things have worked against this company. But it's also going to mean that a lot of potential revenue streams never really developed for this company. If you're looking at Topo Chico, which is sparkling water. If you're looking at AHA, which is sparkling water. If you're looking at Dasani, which is regular water. If you're looking at Smart Water, which is regular water. Did these things see such a decline in the summer months? Despite the fact that the sparkling and regular water markets are growing to such a degree? It is hard for me to believe that. But it is, of course, possible. So I'm going to be watching that stock very closely this week to see if we're hitting that second bounce, where it goes. That is all I have for this week. It helps me out immensely if you hit the like button on this. If you have gotten this far in the video and you have not subscribed, I'm looking to do a weekly investor at least once a week, obviously by the name of this series. But I'm also looking to do other business type stories throughout the week, Tesla stories. I've got a couple Tesla videos on the channel already. I'm looking to get more into production of those type of videos. I also do Ask Me Anythings on this channel. I also do movie reviews. I also do movie news. I also do trailer reviews. I also do some storytelling type stuff. I also, basically stories, There's a lot of stuff I do on this channel. So stick around if you would like. I would appreciate it. And don't forget that I do run the channel Stripped Cover Lit, which you can always look up. But that is all I have for this week. I hope to see you next week for the Weekly Investor number 14.